What if you could literally make money when the stock market does absolutely nothing? When the market goes sideways, it's the worst. You check your portfolio day after day, and it's just flat. Nothing. It feels like your money is just sitting there doing zero, and it's so boring. But for a few smart investors, these boring, flat markets are actually a giant opportunity. In this video, we are going to expose a secret type of investment called arbitrage funds. These funds are literally designed to make money from tiny price differences that almost nobody knows exist. They're built to turn the market's weirdness into actual money, no matter if it goes up, down, or sideways. We'll break down how they work, who should use them, and why they could be the one thing you need when everything feels like a complete mess. First, let's just be real. A sideways market is a massive headache. Most ways to invest are all about guessing the direction. If you buy and hold stocks, you need them to go up. If you're a trader, you're trying to buy low and sell high. Both of these depend on one thing. The price has to actually move. But what happens when it doesn't? In a sideways market, prices are just stuck. They bounce around, but the highs aren't getting higher and the lows aren't getting lower. This can last for months, and it feels like the whole market is just broken. When this happens, all those strategies just fail. The excitement is gone, and you're just stuck. And honestly, being stuck is the absolute worst feeling in investing. You did the hard part. You saved money. You invested it, and the market just decides not to show up. You watch your portfolio barely move for weeks, even months, and you start to get crazy impatient. You start asking, should I just sell everything, or should I make some insane bet to try and force a win? This is where so many investors lose. They either get bored and make a crazy risky trade, or they just give up and pull all their money out, which means they miss the next giant bull run. It feels like your only choices are to either gamble or get literally zero returns. But what if there's a third option? One that doesn't require you to be a psychic. And this is where arbitrage funds come in. These are insane mutual funds built to make money from price differences, not price direction. They run on a simple genius idea: arbitrage. Let me give you a crazy example. Imagine you're at a flea market and you see a rare comic book for $50. But you're a genius, and you know a store across town is buying that same comic for $55. You could buy it for $50, run across town, and immediately sell it for $55. Boom! $5 profit, instantly. You didn't have to guess what the comic would be worth next year. You just used a price gap that existed for a split second. Arbitrage funds do that exact same thing, but with stocks and something called futures. Their entire game is to find these tiny price gaps and make money from them. And since they aren't betting on the market going up or down, they are completely market neutral. Their success has nothing to do with the wild swings of the stock market. So how do they actually do this? The most common approach is cash and carry arbitrage, basically pitting the regular stock market against the futures market. Here's the simple version. Cash spot market. You buy a stock now at today's price. If it's $1,000, you pay $1,000 and own the shares. Futures market. A contract to buy/sell the same stock later at a price agreed today. That futures price is usually a bit higher than spot. The difference is the spread. When the spread is big enough, a fund can act spot the gap. Stock XYZ trades at $1,000, while the 1-month future is $1,020. Put on the trade. Buy the stock at $1,000 and sell the future at $1,020, locking in a $20 gross spread. Hold and settle. At expiry, cash and futures converge. The fund delivers the shares into the future. Result? Roughly $20 minus fees. One trade is small, but repeated across many stocks, sizes, and days. It can add up. Because the position is long spot/short future, broad price moves mostly offset. The edge comes from the spread, not direction. Of course, nothing is perfect. Arbitrage funds have good things and bad things. Let's start with the good stuff. Low volatility. Because these funds don't ride the market's crazy roller coaster, they are way more stable than normal stock funds. They are built for stability, which is amazing when the market is pure chaos. Not reliant on market direction. Their strategy works if the market is up, down, or completely sideways. A little bit of chaos is actually good for them because it creates more of those price gaps they hunt for. Tax efficiency. In a lot of countries, the money you make is taxed like a stock investment. This can mean you pay way less in taxes compared to something like a savings account, especially if you hold for over a year. Now, for the stuff you have to watch out for. Modest return potential. This is the big trade-off. You are not going to get rich off these funds. The returns are usually small and steady, not explosive. Returns aren't guaranteed. The fund only makes money if those price gaps exist. If the market becomes super flat and boring with no volatility, those opportunities can completely disappear, and returns can drop to almost nothing. Watch the fees. These funds are managed by pros who trade all day, which means they can have higher fees. You have to pay attention because those fees can eat your profits. So who should actually buy these things? Arbitrage funds are perfect for a very specific person. They're usually best if you have a short-term goal, like a few months to a year. If you have a pile of cash you want to protect from the crazy market but you want to earn more than a savings account after taxes, you should check these out. They are especially amazing for people in higher tax brackets, where saving money on taxes makes a giant difference. If you're a conservative investor who just wants to protect your money but still have it do something, this is for you. But they're not for everyone. If you have decades to invest and you can handle more risk, you will almost certainly make way more money from normal stock funds in the long run. Every market needs a different tool, and the more tools you have, the more you win. If this video was helpful, and you want to learn more insane ways to invest, I have a challenge for you. Smash that subscribe button and ring the notification bell so you never miss a video. And if you have any questions about arbitrage funds, drop them in the comments below. I try to read every single one. So a sideways market doesn't have to mean your money does nothing. While everyone else is sitting on the sidelines waiting, arbitrage funds are working behind the scenes, grabbing tiny profits from market glitches that happen every single day. They do it by buying a stock in one place and selling it in another at the exact same time, locking in a small but consistent profit. And they give you a much smoother ride and a tax-friendly way to park your cash for the short term, but you're trading huge growth for that safety. Arbitrage funds are not a magic bullet to get rich, but they are a powerful tool for investors who understand you don't always need the market to go up to win. Sometimes, you just need to know where to look.